Very good morning to everyone. I am Dr. M.V.S. Sudhakar, working as Associate Professor in the Department of Management Studies, BVRIT, Narsapur. So today I would like to make a presentation on key metrics of financial risk. So this is one of the topic which is there for us in risk management financial derivatives. So in the risk management financial derivatives, we have how to measure the risk concept. Measuring the risk is very, very important because every investment decisions is subjected to some type of risk. So the meaning here risk is there is a probability of expected loss of your investment. So that is called as the risk when it comes to investment in finance, when it comes to financial investment. Now, how this particular risk is calculated, that's very, very important. What are the metrics that are available for us to calculate the risk? That is the talk of the lecture today. So financial metrics helps us to know that what is the risk amount, or we will quantify the risk that is there to make before making an investment. So when you could able to know how much risk is there of an investment that you plan to make, then you can make a decisions regarding to whether to make an investment or not. Because every investor, he will have a risk appetite. The meaning of risk appetite is the ability to take the risk. So if the risk of investment in any investment alternative is exceedingly over his risk appetite, then he may not invest in that. That is not suitable for him to make an investment. In that sense, we need to learn about what is this risk matrix, financial risk matrix, and how to calculate this particular, risk matrix, and then with the value that we derive out of the calculation, from that what is that we have to interpret and how we have to go with a decision relating to whether to make an investment or not. So that is all about today's topic for presentation. Now let us learn firstly what is the meaning of financial risk. So financial risk is the possibility of losing money or experiencing a financial loss due to various financial factors, various factors affecting investment or business decisions. Okay, so this is the possibility of losing the money or experiencing a financial loss due to various factors affecting investment or business decisions. So here the point that you need to understand is here you have so many investment alternatives to invest. One is you can invest in equity shares, you can invest in gold, you can invest in government securities, government bonds, you can invest in real estate, you can invest in many other investment alternatives. Those are investment alternatives, but they are not financial instruments. But when it comes to financial instruments, we have shares, bonds, okay, and then we have ETFs. All these are the various financial investments. Even you can invest in gilt securities that is issued by the government of India. So these are the financial instruments, and if you invest in these financial instruments, there is a likely chance that your investment may appreciate. The value of your investment over the period may appreciate, or there is equally chance that the value of the money that you have invested, the investment value, it may also come down. Various reasons are there for that. Okay, the companies in which, in the shares in which you have invested, its value may go up because of the performance of the particular company. So thereby what happens is the market price of that particular share, as it increases, your total investment will also increases. Okay, yesterday in news I have seen that IndusInd Bank, it has shown a loss of 2,400 crores for this particular quarter. Naturally, what happens is with that, the perception of the people relating to this particular Indus Investment Bank, so they think that something is going on, something is fishy with respect to the banking operations, and the investors who have already invested, they start selling this investment in that particular stock. Thereby what happens is the value of the share comes down and your investment in that company will also comes down. We say it is called as a financial loss. Various factors are there with respect to the incurring of the financial loss out of your investment. Okay, so that factors may be investment factors, or it can be categorized in different categories, environmental factors, or maybe so many other factors, business decisions. Okay, some are internal in nature, some are external in nature. So all these factors, they see that the investment of your company in which you have invested, or the shares in which you have invested, its value may appreciate or its value may come down over the period. So it can stem from market fluctuations, changes in interest rates, credit defaults, operational failures, or external economic conditions. I am not emphasizing much on this particular the factors which causes change in the value of your investment. So that is not the subject matter of this particular presentation. The subject matter of this presentation is all about the how to calculate the risk of an investment. What are the risk metrics that we have? Anyway, as this is given for us in the slide, I will also throw some light upon these particular factors. Okay, some market fluctuations may happen. This we say it is a systematic risk of investment. So the market fluctuations these days, when you see more volatility is there in the stock market. See, there is some time ago the Sensex value, it has came down to 72,000, and the other time what has happened is the Sensex value has increased. So the point what I am telling is there is a higher volatility these days with respect to investment is concerned. These are called as market fluctuations. As these market fluctuates, as the market there is a higher volatility in the market, what happens is naturally the price of the stocks in which you have invested, it may go up or come down. Thereby what happens is the value of investment accordingly it will also change. It may go up or come down. And the other one is interest rates. Interest rates always the RBI time to time considering the inflationary tendency in a country, they adjust the inflation, they adjust the bank rate, repo rate, and thereby what happens is it also leads to changes in the interest rates. And it will have an impact on the price of the stocks as well as the bonds. It will majorly have an impact on the price of the bonds. And credit defaults. These are operational failures of the company, economical factors, just now we have discussed about. So there are socio-economic factors which is causing the stock market to be more volatile these days, particularly these 2 months time period. So this makes the value of your investment may go up or come down. The point what is that we have to learn here is how to measure the risk. There are various metrics that we have which makes us to understand that how risky an investment alternative is. So that we will now deep dive and learn about these particular key metrics, key risk metrics. Okay, first one is value at risk. We also in short call it as VAR. So VAR estimates the maximum potential loss of an investment or a portfolio or a specific time period with a given confidence level. So certain points we need to consider. Where what it says is, it says about what is the maximum amount of loss that you are going to incur by making an investment in a certain period of time with a given confidence level. That is all about the VAR. Okay. So here VAR is calculated with the help of the formula that is also given here on the screen. So VAR, this alpha talks about the confidence level. At 95%, usually we take 95% confidence level, 99% confidence level we used to consider. So that alpha value we are going to put there, and Z score, this is the value of the normal distribution at 95% confidence level, and then alpha talks about the standard deviation, and T values talks about the time period, right? So there is an example which makes you understand about how to calculate the VAR. A portfolio has a daily standard deviation of 2%, right? Standard deviation, I am talking about alpha. So standard deviation of 2% at 95% confidence level, the 1 day VAR is calculated like this. So VAR at 95% is equal to this Z value. This is from normal distribution, we have got this Z value. Z value at 95% is 1.65 into standard deviation 2%. I am calculating it for 1 day. That's the reason we say T value is 1. If we calculate it for 30 days, T value will be 30. If we calculate it for 15 days, T value will be 15. And the value which I have got is 3.3%. Now what is that we have to understand from this? That is very important. So there is a 95% chance that the portfolio will not lose more than 3.3% in a day. That's called as VAR. It says that what is the possibility, with how much probability we are going to tell that in the next coming 1 day or 2 days or 3 days time, The maximum loss that you are going to get, here it is 3.3% of your total entire portfolio. So that is called as VAR. So standard deviation. So standard deviation, we know it's a very good statistical measure. It talks about volatility, how volatile the stock is. So standard deviation usually will calculate from the returns of that particular stock. It will not directly calculate with the price. So we will calculate the daily returns of the stock or monthly returns of the stock, and upon which we will calculate the standard deviation. So with that standard deviation, we will say that how volatile is the returns of that particular stock. If the standard deviation value is very high, we say that this particular stock is highly volatile and more risky to invest. If it is very less, that particular stock is less risky to invest. The standard deviation measures the dispersion of the returns from the mean or average. Higher values indicates more variability and risk. Okay, so that's about the standard deviation. It's one important metric, and I have given here the formula also to how to calculate the standard deviation. So sigma is equal to root of 1 by n minus 1 into summation of I is equal to 1 to n. So Ri minus R bar is the average mean. Ri is the individual mean. Okay, n stands for number of days or number of units that you have considered for calculation. Now, beta is another important metric which talks about how volatile a particular stock is with respect to the market portfolio. That is the beta. So, beta measures the sensitivity of an asset's return to the market returns. How sensitive the individual stock's returns with respect to the market returns, that will be given by the beta. So, a beta of less than 1, it implies, a beta of more than 1, it implies, it's a more volatility than the market. Suppose if a beta value for one particular stock, Reliance Industries, let us consider, if you calculate the beta value and if it is 1.5, what it says is, so the Reliance Industries stock price changes 1.5% times when the market changed by only 1%. Okay, so beta talks about how sensitive the individual stock returns is with respect to the market returns, right? And it is calculated with the help of the formula. Beta is equal to covariance of, so RA is the stock return of any company that you are considering, and RM stands for the market return, divided by variance of market return. So example is given for better understanding. A stock with a beta of 1.2 tends to move 1.2% for every 1% move in the market. So how volatile it is, then we say that this particular stock, A stock is highly volatile when compared to the market returns. So it changes every time the market returns changes by 1%. The return of A stock is going to change by 1.2%. So this is how we need to understand. Sharpe ratio is the other metric. It measures the risk adjusted return, showing how much return is earned per unit of risk. Okay, so how much return you are going to earn per unit of risk, that is calculated with the help of the Sharpe ratio. So one other important metric usually used in the corporates, Sharpe ratio is equal to RP minus RF by, okay, so it's a standard deviation of the portfolio. Okay, so RP stands for portfolio return, RF stands for risk-free return, and standard deviation of portfolio return is given by sigma P, and then a higher Sharpe ratio indicates better risk-adjusted performance. So when you see that with this formula, if you calculate the Sharpe ratio, and if the Sharpe ratio comes out to be higher, then we say that it's better performance. It's showing better performance. Okay, so that is what we can understand when you calculate the Sharpe ratio. Trainer ratio is another ratio. It measures returns earned in excess of the risk-free rate per unit of market risk. Okay, so returns earned in excess of risk-free rate per unit of market risk. The formula is RP minus RF by beta. Shows how well the portfolio compensates for market risk. Okay. So the other metric is then the maximum loss. This is also another metric which usually be used by the corporates to calculate the risk, or the investment managers to calculate the risk. Now the worst the worst case loss scenario for an investment under extreme adverse conditions. A higher stock, a high risk stock might have a maximum historical daily loss of 25%. This metric is especially used in stress testing. So this is very, very important. See, the word itself, the nomenclature itself says that it's a maximum loss that we are going to get in the worst cases. That's called as the maximum loss. The worst case loss scenario for an investment under extreme adverse conditions. So a high stock might have a maximum historically daily loss of 25%, right? So if any stock, if it is more than 25%, then if you calculate the maximum loss, and if it is more than 25%, suggests that it's not a stock to invest, because it is of highly risk, highly volatile, right? So with this I completed. Yeah, we have another one also, that is CVAR. It's an extension to VAR. So CVAR stands for conditional value at risk. Okay, so this is also called expected shortfall. CVAR estimates the average loss beyond the VAR threshold. So we have calculated VAR. VAR talks about at 95% confidence level, what is the maximum loss that we are going to get in 1 day time, or 10 days time, or 3 days time, whatever may be the time period that we have considered. And CVAR talks about out of that particular loss. So out of that particular loss, how much will be the maximum amount? Okay. So that is called as a CVAR. So also please try to understand this very, very carefully. Also called expected shortfall. CVAR estimates the average loss beyond the threshold. Okay. So I want to show you that, for example, it's a normal distribution curve, and suppose this is a one-tailed curve. For your simple understanding, I am telling the one-tailed curve. And this is the 95% part, and this is the 5% part. Now, VAR talks about what is the maximum loss that we are going to get. Okay, with 95% confidence, we can say that the maximum loss that we are going to get in 1 day time, or 2 days time, or 6 days time. And CVAR talks about the average of the losses, okay, of these particular losses. That's about CVAR. Okay, so here an example is also given for that. If VAR at 95% confidence is 10,000, and the average of the worst 5% losses, this is the worst 5% loss, is 15,000, then the CVAR is 15,000. CVAR is more informative about extreme losses than VAR alone. VAR only talks about maximum loss, whereas CVAR talks about, okay, what is the average loss at that particular 5% level. So these are the various metrics which helps us to assess or calculate the risk of investment in any investment alternative. Thank you.
Vishnu Audio Visual Center, like and share and subscribe and click bell icon.